Good morning, everyone. My name is Susan Bryant. I'm a CPA at the MB Group, and I just wanted to welcome you to our webinar today. I'm going to give everyone just a few moments to successfuli join the webinar this morning as we embark upon S-Corp 101. So in the interim, just some housekeeping here. If you have any questions that you would like to ask, please put those in the Q&A and we'll try our very best to get to those at the end of the webinar. We have about 1 hour. We've got a lot to cover, so we are going to move rather quickly through the materials. So welcome again to everyone to our webinar from the MB Group. Again, my name is Susan Bryant, and we are going to be talking about subchapter S corporations. This is a extremely hot topic for a variety of reasons, and one of probably the most favorited entities, although sometimes there are some things that are quite misunderstood. So we're going to jump right in. The first thing that I want to talk about today is the fact that we really don't start with the entity at the federal level. We start with the entity formation at the state level. Usually when people come into us, the first thing we ask them is, what is your entity type? And they'll say, well, I'm an LLC, and that is great for state purposes, but that doesn't necessarily mean what type of entity they are from federal taxation standpoint. So from a state standpoint, you can be a sole proprietor, you can be a limited liability partnership, a professional limited liability partnership, a limited liability company, a PLLC, a corporation. And that is what gets formed at the state level. Your attorney is the one who is usually guiding you and directing you on what entity is best based on the type of partners or owners that are going to be in the entity. And then that is paired with what are you going to be from a federal tax standpoint. I think that it is fair to say that these days, most small owner-operated businesses are typically recommended by their attorneys to become limited liability companies. So we're going to spend a lot of time talking about that. So the other thing that you have to know is, from a federal tax standpoint, you can be one of 4 different types of tax designations. So you can either be a sole proprietorship, which files on a Schedule C on your 1040. You can be a sole member LLC, so disregarded for tax purposes, again, reported on your Schedule C of your 1040. You can be a partnership, an S-Corp, or a C-Corp. Those are the designations for a federal tax standpoint. Some of the entities at a state level will be required to file a certain tax form for federal purposes. Some have some flexibility. So I want to talk a little bit about that coming up next. And that is the limited liability company. That entity has the ability to really be all 4 types of federal tax designations. So I'm going to talk a little bit about what this is. The LLC is a legal business structure formed under state law, limited liability company, or a professional limited liability company. You might ask, well, what's a PLLC? Why is it different than an LLC? A PLLC is an entity that contains a professional, owned by a professional, like a doctor, a dentist, an attorney, an accountant, someone with a professional designation. So the LLC is often recommended by attorneys. And again, I'm not an attorney, but attorneys typically recommend these entities because they really do segregate your personal risk from your business risk. And they are segregating that liability. And that's very beneficial at times in order to really make sure that you're protecting all the personal assets that you've built up. Also, LLCs are very easy to maintain under the state law. So unlike corporations, there's no requirement for board of directors meeting minutes and resolutions, all the things required to maintain a corporation in good standing with the state. And then, as I alluded to earlier, the LLC also has some great flexibility in terms of federal taxation. You do have to know that anytime you form an entity in a state, you are going to have some type of reporting obligation in order to maintain that entity in good standing. So LLC structures. So if there is one member of an LLC, you have the option for your entity to be disregarded for tax purposes. And that's usually how we refer to it, either single member LLC or disregarded entity for tax purposes. This type of entity with one owner in an LLC by default would file a Schedule C on the Form 1040 of the owner. And any income that is generated from this LLC would be considered to be self-employment income. It's a really important concept for people to understand. And usually most businesses who start off with just one owner, this is usually where they start in terms of filing for taxes. And then the other designation that an LLC by default will be, if it has more than one owner, so 2 owners, would be a partnership. So when you go and you form an LLC, it has more than one owner, it will by default be a partnership. A partnership is a pass-through entity. It issues a K-1 to its members. There can be multiple classes of stock or interests in a partnership. And an interesting thing about a partnership is that it can have a disproportionate allocation of both income and distributions as it pertains to ownership. So for example, I can be allocated 100% of losses, but only own 50% of the business. The other thing about partnerships is if I'm active in them, then that income is considered to be self-employment income. So that's a really important concept. So the S corporation. So an LLC can elect to have a S corporation taxation status. Again, this is probably one of the things that makes the LLC so flexible. As you can see, it has a variety of options. An S corporation has inherently some limitations in it though. And so it can have 1 or more owners. It does file a separate tax return. It's a pass-through entity, but it can only have 1 class of stock. So there can't be multiple types of interests in an S corporation. And probably most notably, the income and any distributions must be allocated proportionate to ownership. This is a requirement and there is no flexibility in that. One of the other things that makes a S-Corp a little bit more interesting is that there are restrictions in terms of who can own it. They have to be a natural person, and there are some restrictions on what type of person. So usually they have to have some type of either citizen status or green card status in the United States in order to own an S-Corp. And then finally, we've got a C-Corp, and this is probably the least favorite option for our owner-operated businesses because it is essentially an entity which is a standalone taxpayer. But if you take any money out in the form of a dividend, it's subject to double taxation. So essentially, at a C-Corp level, you pay tax revenue minus expenses on the profits of the company. And then if you take the money out in the form of a dividend as an individual owner, then you pay tax on that dividend at an individual rate. So there are the 4 ways that an LLC can be taxed. So a lot of times people come into our office and the first thing, we'll ask them is, well, what type of entity are you? And they'll say, I'm an LLC. And we'll say, how are you taxed? And they don't know. It is probably one of the most common things that owners don't know about their business. So now you know that it can be taxed one of 4 ways. You're either disregarded for tax purposes, filing a Schedule C. You're either a partnership, S-Corp, which you've elected, or C-Corp, which you would also have elected. So those are the 4 different ways. Now, I know you came to this webinar to learn more about S corporations. And so I want to spend a little bit more time just talking about what is an S-Corp. So you have to be an entity in order to make an election to be treated as an S corporation. So sometimes people will come to us and they are operating as a sole proprietorship. A sole proprietor cannot make an election to be treated as a S corporation. So that has to be an entity that's making that election. So typically either a corporation or an LLC. As I had mentioned before, there are limitations on the shareholders that are allowed, individuals, certain types of trusts. There are definitely no corporations or partnerships or non-resident aliens that are allowed to own stock in an S corporation. So there are some significant restrictions and limitations on who can own this company. No more than 100 shareholders, only 1 class of stock. So it is not uncommon for us to see people who accidentally issue another class of stock and they by default bust their S election. And that can be very dangerous. So, so just keep that in mind. And then you must also not be an ineligible corporation. So there are certain types of like banks and other entities from an industry standpoint that are not allowed to be S corporations. So what's so great about becoming an S corporation anyway, right? I mean, so why do people care? Why do we hear a lot about this? What is so great about the S-Corp? So there are some significant benefits to becoming an S corporation. One of them is this concept of it is not subject to self-employment tax when the income that passes through from an S corporation to your personal return is only subject to federal income taxes. So let me kind of give you, kind of break this down for you. When you are a disregarded entity for tax purposes, so you are filing a Schedule C. On the Schedule C, you will report your revenue, all of your expenses, and at the bottom, you'll see a line that says net self-employment income. That self-employment income is subject to Social Security and Medicare, the self-employment tax, both both sides of it. So the employee and the employer portion, as well as federal income tax. So the more money you make on a Schedule C, the more you're going to be taxed. There are some ceilings, as you are probably aware, in terms of Social Security, but there is a Medicare portion which goes on forever on the Schedule C. So when we look at making an S election, so moving from the Schedule C filing to moving to an S corporation, when we make that election, the first thing that happens is that in an S corporation, we pay tax, revenue minus expenses, same thing. But when that income passes through to your 1040, it's only subject to federal income tax. So we are bypassing essentially the self-employment tax portion of that. Well, the IRS knows this, and they say, well, in order for you to enjoy all of the benefits of this S corporation, you are going to have to pay yourself a quote unquote reasonable salary. And that means that you are going to end up paying some Medicare and Social Security, that FICA tax, but it's going to be determined based upon how your time and effort are dedicated to your company. So it's no longer just a function of how much money you make. And if you make more, I pay more tax in self-employment taxes. I get to determine exactly what I want that self-employment tax to be based upon the nature of my job responsibilities in my company. So secondarily, from a double taxation standpoint, it doesn't exist in an S corporation. Because I pay as an S corporation owner, I pay taxes on revenue minus expenses. The cash that's left over from my company, whether I take it out or not, is not going to be subject to any more tax when I remove the cash from my company. I pay tax on the performance of the entity, not the cash that's coming out. That is frequently something that people totally must understand about S corporations. They think, well, if I took the money out, it's subject to taxation. That is not necessarily true. However, one area we do see people run into problems is that they take money out throughout the year. So revenue minus expenses, I'm taking money out as my company earns money. I got to remember that's pre-tax profit distributions. So at the end of the year, I'm going to have to add up how much money I actually made, revenue minus expenses, my net income, and I'm going to have to make sure that I've got cash to pay the taxes on the performance of my company. So it's really an important concept. We see people all the time who get very confused about the notion of distributions and that distributions are somehow taxable. They are not taxable. Maybe, right? There's always a disclaimer from the tax standpoint. But from a normal profit standpoint, revenue minus expenses, if I take the money out, it's not taxable when I take it out. It's taxable at the end of the year when I go to pay tax on the performance of the company. One of the other benefits of an S corporation is the character of income stays the same when it passes through from the S corporation to my individual tax return. So if I make ordinary income, it's ordinary income on my 1040. If I have capital gain income, it's capital gain income on my 1040. Interest income, dividend income, and then similarly expenses like charitable contributions, those pass through to my personal tax return as well. So it is one of those areas where we get to still enjoy the benefits of all the different types of income we might earn when it passes through to our individual tax return. So that is an important concept. One of the other benefits of an S corporation is that it files a separate return. So there is some segregation between what's happening from a personal standpoint and a business standpoint. And I know that there are a lot of people who don't necessarily want to pay for another tax return. But when you have to provide information to a third party about your business, it is nice to be able to share that information without sharing all of your personal tax data. So that is, to me, one of the benefits. And then again, going back to the concept that everything in an S corporation must be tied back to ownership percentages. So income allocation, loss allocation, distribution allocation. The inflexibility is also one of those things that can be extremely beneficial. So if you're in business with another individual, You know that if you're 50-50 owners, if they take out $100, you're going to get $100. If they're allocated $1,000 in income, you're also allocated $1,000 in income. That's how that entity works. So it has some safeguards in it that allow for the protection of your interest in the company, and making sure that everything is always proportionate to ownership. Now, many of these things can also be considered to be downsides of the S corporation. So like I had mentioned before, you got to run payroll, you got to pay yourself a reasonable salary. It's one more thing to do. Now, for businesses that already have employees, it's no big deal. But if you are a one-man show and now you've got to start running payroll, it is a service that you've got to subscribe to. Now you have the obligation to remit your payroll taxes on time. You've got to file employment tax returns. Those are quarterly 941s. You've got to pay the annual 940 FUTA taxes. You've got to register with the state to pay state unemployment taxes and file those quarterly returns, issue W-2s. I highly recommend that people subscribe to a service to do this, because if you get it wrong when it comes to payroll, the penalties are significant. So I would tell you that it is a really important concept for individuals to really take note of. Get a payroll service and let that get handled. It's worth the money to just get out of having to do that. But it is one more thing that you have to do. As I mentioned to you before, you got to file another tax return. So there is an added cost to having an S corporation. It files a Form 1120S and you got to file a separate tax return. So this is a really important thing for you to know about. It has to file a return by March 15th every year, and it can be extended to September 15th, but it is a separate tax return that needs to be filed. You've also got to maintain better books and records than you would if you had a Schedule C. And not that I'm saying that you don't have an obligation to maintain adequate books and records with a Schedule C filing, but there is a little bit more a leniency that's on the individual taxpayer than there would be on a business. So you have additional scrutiny, and you got to make sure you're producing balance sheet, income statement. You've got a detailed general ledger. You have basically everything to back up that Form 1120S when it gets filed. So it's a really important concept for you to implement solid accounting records for your S corporation. So this is a business now. We're not going to operate it like a side hustle. It's not just going to be something that's, happening infrequently on the side. This is the real deal, and you've got to have the accounting records in order. So this is the time where we see most people who are moving to implement QuickBooks or some other type of accounting software. So they really have to make sure that they've got adequate books and records for the company, support the tax return. And then we mentioned the lack of flexibility before. That can sometimes be perceived as a downside for some entities. For some, it's a great control. For others, they don't want that. They want to have some flexibility in terms of allocation of income and expenses and distributions, and the S Corp just simply will not provide that. The other thing is that from an S corporation standpoint, the year end has to be a 12/31 year end, because the year end will match the year end of the owners, and those are required to be individuals. So it has to be a 12/31 year end. And those are usually the things that are the downside of the S corporation. Let's talk a little bit about payroll. I often refer to payroll as a tool in the toolbox for an S Corp shareholder. And the reason why that is because we want to use it differently. Most people, when they convert from even just an employee to a business owner, they have a hard time getting through this notion that the employee payroll is not going to happen on some type of frequent basis. Like usually if you're an employee, you're getting paid bi-weekly or semi-monthly. When you become a business owner, and especially an S Corp owner, and it's just you as a single employee in the company, we don't run payroll that way. Payroll for us is more of a tool. And there's a few reasons why we consider it that way. The first thing is that we use it to pay in taxes. Okay, so we use it to make sure that we're setting a reasonable salary. We're using it to pay in our fair share of the Social Security and Medicare taxes, but we're also using it to pay in our federal income taxes that are getting withheld. So unlike when you are a normal employee working for somebody, they're taking out the commensurate amount of federal income taxes based upon the income that you're earning. When we as tax planners use your wages and payroll in an S corporation, we're looking to say, how much income are you going to have overall on your 1040 and how much tax do you owe? And we pay those taxes in with a payroll, a big giant bonus payroll at the end of the year, instead of you having to pay those taxes in a little bit at a time. And the logic here is that two things. One, I want you to keep your money in your pocket, working in your business as long as we possibly can. And two, I know that the IRS perceives that income tax withheld from a paycheck is deemed to be evenly paid in throughout the year. So unlike estimated quarterly tax payments where you've got to pay them in on 4/15, 6/15, 9/15, 1/15, you've got to let go of that money throughout the year. And if you don't pay your taxes commensurate with how your income is earned, you can get penalized for underpayment. When you pay your income taxes in via payroll as federal income tax withheld, the IRS deems that to be evenly paid in throughout the year, even if we pay it all in on December 31st. So it is a great tool to us for us to bypass ES payments, for us to avoid underpayment penalties for not paying those taxes in commensurate, with our income earned on a quarterly basis. So it's a tool for us. The other thing that we use it for is that we know that if there are benefits, fringe benefits, such as medical benefits, we are making sure that we're using the payroll in order to capture the greatest benefit of that. So there is a requirement for more than 2% shareholders of S corporations to include in their W-2 wages the S-Corp premiums for medical insurance paid on their behalf. We use that as a tool because we know if we include it on your W-2, then we get a preference deduction on your 1040 for the amount of those premiums. So we not only from a compliance standpoint use that, but we also use it as a tool to make sure we're getting you the best benefit of the deduction. The other thing that we know is that from a retirement standpoint, the amounts that can be run through payroll and how they are treated from an employer standpoint, in terms of retirement contributions and deductions, they're calculated differently than if I was a self-employed individual reporting on a Schedule C. And I'll give you an example. So if I was going to set up a SEP IRA, so a self-employed person's IRA, if I was filing a Schedule C, I would have the opportunity to contribute 20% of my net self-employment income to my IRA. That's awesome. And there's a statutory limit on that every year. But if I am an employee of my company, my S corporation, and I receive a W-2, the company, the employer, can make a contribution of up to 25% of my gross W-2 wages. So as you can see, there could be a great difference there in terms of the amount of deduction that I am able to receive from a retirement standpoint. And of course, there is a ton of options when it comes to retirement plans, from setting up a 401k plan to a cash balance or defined benefit plan. So there's a lot of different options that are available to us. And in many cases, we gain some additional flexibility and deductions when we are functioning as an employee of our company versus if we are self-employed. So that is something to keep in mind for sure. And then last but not least is the wonderful qualified business income deduction, which was the creation of the Tax Cuts and Jobs Act that passed at the end of 2017. So, and now we're going to kind of jump into that, because that is something that is really important. And these two things work together. The payroll and the QBI work together in certain instances where you're beginning to make a lot of money and exceeding the income limit. So let's talk about what is QBI and why do we like it. So let's just talk a little bit about who gets QBI. So Schedule C filers can receive QBI deductions. Now there's limitations on all of this. If you have employees in your Schedule C, which is totally possible, that are not you do not get paid from a Schedule C, but you may have employees who work for your Schedule C, single member LLC business. That's totally possible. So there are certain instances where a Schedule C filer may receive it. There are certain instances where a partnership will receive qualified business income. And then there are certain instances where a S corporation is going to receive qualified business income deduction. A C corporation does not get qualified business income deduction at all. Okay, so how does the QBI work and why do we care about it? So essentially what happens is that when income passes through from your S corporation to your 1040, you may receive up to a 20% deduction of that qualified business income. So you're essentially shifting income from 100% taxation bracket to an 80% taxation bracket when you are moving from a Schedule C to a S corporation. Of course, there's certain parameters and calculations, but that's essentially what's happening. Now, what we do know is that when you start to exceed certain income thresholds, you have to have W-2 wages in order to continue to capture the 20% deduction. So the way the calculation works is basically like this. The QBI calculation or deduction is the lesser of 50% of your W-2 wages or 20% of your QBI. Okay, well, if you don't have any W-2 wages, you're not going to get any QBI. So for us, the payroll is an important, almost vital to the calculation of determining exactly what you're going to get from a QBI standpoint. Now, if we do too much in wages, then we are essentially taking too much out of our 80% taxation bucket. If we do too little, then we don't get the 20% tax, the 20% deduction that we are entitled to. So in my mind, the payroll in an S corporation is what I refer to as a Goldilocks problem. It's got to be just right. Has to be. We have to be thinking about that. Now, for some lucky people in some industries, they are not going to get any QBI if they exceed these income thresholds. It's going to be doctors, lawyers, accountants, consultants, financial advisors, athletes, celebrities, people who are, basically using their likeness for an endorsement of some kind. But all other businesses qualify. So there are some really amazing opportunities for businesses right now, but it's not going to last forever, or it's not slated to last forever right now. This deduction sunsets in 2025. So now is the time to be taking advantage of the maximization, the optimization of the qualified business income when it comes to your S corporation. This is a really big key that we see this missed all the time. It is probably one of the areas where we can make such a significant impact for our business owners, is that we just got to get the wages just right in your company. Or you're just going to miss the deduction completely. And more often than not, what we see is that there's no wages versus that there's too much wages. So people are just missing the boat on running payroll for themselves. So, and they're also not being compliant with the rules. I mean, they're not paying any Social Security, Medicare in the S corporations. And so they're just sort of leaving so much money on the table when it comes to QBI. So a big deal and really important. So QBI is a big component of that. So this is probably one of my favorite quotes about taxes, because I am also a mother. And they are generally misunderstood. Taxes are misunderstood, and mothers are usually too, especially when you've got teenagers like me. So one of the things we talked about earlier is that if I have paid myself my payroll and I pay my payroll taxes on that, but I still need more money out of my company, can I take money out? You sure can. Yeah, people take distributions all the time out of their businesses. And what's great about it is that when you take money out of your S corporation, it is not subject to Social Security and Medicare tax. The only thing it's going to be subject to is federal income tax, because when that income passes through, revenue minus expenses passes through to my 1040, I'm only paying federal income tax. So if I take the money out in advance of my tax, annual tax return, I'm essentially just advancing myself on pre-tax profits that are going to be subject to federal income tax. You can take it out. Now, as I mentioned to you before, if you have multiple owners, you've got to make sure that you're doing everything proportionate to ownership percentages. You can't make them disproportionate. You will get you will essentially be in violation of that. And we, as your tax preparer, we will not permit it. So we'll make some adjustments that will essentially true that up and make sure that those things get equaled out in the following year. The other thing is stock basis. So if you take out too much money in the form of distributions and you don't have basis to support that, then there's going to be some limitations on what you're able to take out. So one of our awesome tax CPAs here kind of likened it like a bank account. So if you put money into a bank account, you put $100 in, you can only take $100 out. If you take more than $100 out, the bank is going to penalize you. They're going to charge you a fee. It works basically the same way in the tax law. So if I don't earn enough money, but I take more money out, and you say, well, how can that happen, Susan? How can you take more money out of your company than you've earned? Sometimes it happens in the form of like debt. People will take out a line of credit or some type of loan, and they'll have more cash in their company and they'll advance it to themselves personally. And when they do, they're essentially receiving a distribution in excess of basis, and that means that they're going to have a potential tax impact in the form of a capital gain. So just keep in mind, though, the most important thing for you to remember here on this slide is that distributions are not taxable. So common misconception, if you take money out of your company, you don't pay tax on the amount of cash, you pay tax on the performance of your entity, whether you take the money out or not. Okay, I was alluding to stock basis, and I'm going to go into a little bit more detail on this. So stock basis is essentially, let me make a liken it to something like when you invested in something. So if I make a purchase of an investment in a company, and it increases in income, right? So it earns money in a year, my basis goes up. That's just sort of the way to sort of look at it. If it loses money, my basis goes down. If I take money out, my basis goes down. The idea is that my basis is essentially all the things that have been accumulated, all the ins and outs of my capital account. I put money in, it made money. I took money out, it lost money. All the ins and outs are essentially my basis. If I go to take money out, though, I have to have basis in order to take that deduction, or I'm sorry, not that deduction. I have to take money out without having a tax ramification. If I lose money, I've got to have basis in order for me to take that deduction on my personal tax return. So those are the things you got to think about when it comes to stock basis. I will tell you, as an S-Corp shareholder, this is probably not one of those areas where you're going to be like, I need to keep track of my stock basis. That's usually our job, but it is also our job to remind you when you do hit some of these limitations, such as I've taken more money out than I have basis, and so I might have a tax ramification from that. Or I have a loss in excess of basis and I don't get a deduction on my personal tax return because I don't have the basis to take that loss. So it matters to you. You're probably not going to spend all day thinking about this, but it does matter in terms of, from a tax standpoint, what we've got going on. So just for your information, but not necessarily for you to have something to worry about. This is really not something you're going to spend a lot of time thinking about. Okay, so now you know that you want to make an S election. You know that making the S election is going to eliminate some self-employment taxes. It's going to be a right fit for you in terms of the fact of who owns your company, the type of shareholders you have, the type of stock that you have, and this is, you know this is direction that you want to go. So what do you do next? So what you have to do in order to convert to an S corporation is you have to file a form 2553. This is a form that gets filled out generally by us as your tax preparer, and is going to be signed by you, and then it gets faxed to the IRS. And it is important to note that in the state of Texas, we are a community property state, and this is not applicable in all states, but it is applicable here. So usually, even though we do not have spouses that are going to own a portion of a stock, so for example, if I own 100% of an S corporation, but I'm married, it's community property state, my husband will still be listed on the 2553 with the 0% ownership, but he still has to sign, and it's his acknowledgement of the fact that this entity is now going to file as an S corporation. So even though he doesn't own any piece of it, he still has a requirement to sign the 2553. So let's talk a little bit about when you need to make this election. So usually, I mean, we have some flexibility. This is probably one of the most wonderful things about an S corporation is that we do have a little bit of flexibility. Unfortunately, there's some revenue procedures that allow for a late election. So we need to file this pretty timely. If it's a brand new entity, we just get it filed on or before March 15th of the applicable tax year. I mean, even when you form the entity, you can go ahead and make the S election if you choose. If you are proceeding along and you say, hey, I want to go back and I want to make an S election, you have some flexibility to go back to the open tax year, the preceding open tax year. So for example, right now it's 2022. We have made some late elections for entities that started in 2021 or that were in existence as of 1/1/2021. And we're making those late elections all the way back to the beginning of January of 2021 so that they can enjoy the benefits of being treated as an S corporation for that period. So now this can be tricky. There are some rules you have to follow. So it is important to get expert help in preparing the 2553 so that you do it right and so that the IRS accepts it. So keep that in mind. Now, it is also not uncommon, especially right now with the IRS, for us to get notices where the IRS didn't successfully process something. So we've received quite a few notices where we fax something to the IRS, we receive confirmation from the IRS, and then a notice comes back and says, hey, you filed the wrong tax return. And in that case, a lot of those things can be rectified. We just have to communicate with the IRS and make sure that they have the election on file and they get it processed. Usually most S-Corps, as soon as they file the 2553, they will receive an S-Corp acceptance letter from the IRS. And so that's usually our indication that we know, of course, IRS has received this. This is what they're anticipating. They have it on hand, and we're permitted to go ahead and file the 1120S now that the 2553 is on file. Now, it doesn't preclude us from filing the 1120S if we don't get that letter. We just might have to do some damage control on the back end if the IRS does get behind, which we know that they are very behind in processing things right now. So, other common questions that come up. So let's just go kind of run through some of these. Cash or accrual basis. What does that mean in terms of being an S corporation? So when you are a Schedule C filer and you're an individual taxpayer who files Schedule C as a 1040, individual taxpayers are by default cash basis taxpayers. You cannot file a Schedule C on an accrual basis. It is just not permitted because it is essentially you as an individual and you are a cash basis taxpayer, period. When we switch to becoming an S corporation, we have an option of actually filing on an accrual basis or filing on a cash basis. And there are differences. So let me give you an example. If I was to be sending out invoices to my customers, I'm invoicing them for my services. That is an accrual basis item. Similarly, if vendors are sending me their bills and I'm entering accounts payable, that is an accrual basis item. I am recording it as either revenue or expense before I pay it. And as an accrual basis taxpayer, I would pay income on my revenue before I've received cash for it, and I've received the benefit of a deduction before I pay it. Now, I will say that in most cases, our owner-operated smaller businesses, usually accrual basis is not an advantageous election. It's not the basis on which we want to be filed, but it is allowable. And in some cases, it does make a lot of sense. But it gives us flexibility in an S corporation. We have the option of choosing. So a cash basis taxpayer, on the other hand, we receive where we pay tax on cash when it's received, and we receive the benefit of a deduction when we pay it. That's cash basis. One big thing that comes up many times for us is, well, I want to keep my books on an accrual basis because I want to keep track of my AR and I want to keep track of my bills. Does that mean that I can't file my tax return on a cash basis? And that is not, no. You can convert your books from, or we do for you, from an accrual basis to a cash basis when we file your tax return. So we can still maintain our accounting records on an accrual basis, keep track of our accounts receivable, who owes us money, who do we owe money to, we can accrue expenses, we can keep track of prepaids, all the things that have to happen in an accrual basis environment, we can still do that. But we do not have to pay taxes on that basis. We can convert those books to a cash basis. But we've got choices in an S corporation. So that's a really important thing. Some other questions that usually come up, what type of life insurance is not deductible? So officers' life insurance premiums are not deductible in an S corporation. And you will often see that any of these differences between what's on the book, so we'd still pay for it in the business, we just wouldn't deduct it on the tax return. And those items are referred to as M1 adjustments. So these are differences between what's deductible on the books versus what's deductible on the tax return. Another question that we get a lot of times is, will I still get forms 1099? So as a taxpayer, will I receive a 1099 if I provided a service to someone? So S corporations are not required to receive 1099s. So your LLC makes a S election, you fill out a W-9 and you send it to people and it says LLC and you'll mark the little box that says S. You will no longer be required to receive forms 1099, which is fantastic. Now, if you get them, does it matter? No, it's no harm, no foul. You can still receive a 1099. It's not going to matter, but you are not required to receive them. So that's a really important benefit because it does minimize the amount of attention that you receive in terms of like IRS filings. And there's just less happening when it comes to your company's EIN number. Another thing that people get hung up on is the idea that especially when they're moving from a sole proprietorship to being an entity, is a lot of times they've been using their social security number for their sole proprietorship. When you become an entity, you're going to get an EIN number, and you apply to receive that EIN number under your entity's name, and is no longer under your social security number. So it has its own identification, and it's great because one thing about moving from using your social security number to an EIN number is that you no longer have to give that out on W-9s. I mean, that's invisible now, and you're sort of keeping your social security number a lot more protected when you're operating under that, the LLC, the EIN. It's just fantastic. So another question is, how should I keep my accounting records? A lot of times people come to us and they have like absolutely no accounting records for their businesses. And that's when we have to really say, hey, look, it's time for us to get some infrastructure. We've got to make sure that if ever you were to be examined by the IRS, we have the ability to represent you. And spreadsheets just ain't going to cut it. So accounting software is needed in order for you to generate all the reports that an IRS auditor would want to see. So I'm talking about detailed general ledger, balance sheet, profit and loss. All of those are going to be key. The other thing that is really important in an accounting software is it's going to allow you to maintain some controls. So for example, let me give you an idea of accounting control that exists when we start using accounting software, is the reconciliations. So when we enter transactions into accounting software, we're entering it usually from some type of a sync. Usually it's a bank feed. Maybe there's some things that are getting manually entered from receipts. There's just a number of ways that data is getting in there. We do not know whether all of those transactions should be in there until we reconcile. The reconciliation function for us is the comparison of what we've entered into the accounting software versus what has actually happened at a bank or a credit card company. And so we're comparing those two. It is a completeness check. It is to make sure that everything that happened in the bank is recorded on the books. And if something got recorded on the books, the question is, why didn't it happen in the bank? Did the check not make it to the bank? Is it still sitting in somebody's desk drawer? It needs to be deposited. Is there a vendor who's not cashing your check? Maybe they didn't receive it. So all of those things that are happening in the accounting records need to be reconciled to what has actually transpired at these third parties, whether it's a bank, credit card company, payroll company, a loan, maybe it's a capital lease entity, whatever it is. Whatever is happening outside of the company has to be compared to what's happening on the books. You cannot do that on an Excel spreadsheet. It is impossible to do it. It cannot happen. The accounting software is what allows for us to manage it and to record it and to report it, and for us to be able to actually show to others, we know that these books are right because here are the reconciliations that occurred, and here's the items that are different, and here's how they got cleared out later. So I've had lots of people come in here over the years to the MB group and say, hey, Susan, I don't need accounting records. Well, the fact of the matter is that if you are a business and you are filing a Form 1120-S as an S-Corp, we will mandate that you have a set of accounting records. So we won't file a return without it. You got to have accounting records. One of the other questions that comes up a lot of times is, how do I set my salary, and what is reasonable compensation according to the IRS? This is definitely something that is it's subjective. Fortunately, there are some ways where we can determine what your compensation should be. There are what we like to call reasonable comp studies that can be performed, and we have software that can aid in these processes. So reasonable compensation is going to be derived from sometimes your industry. So, if you're a doctor versus you are a florist, you're going to have a different pay range based on your duties and responsibilities. Even sometimes within, different types of physicians, if you're a brain surgeon versus you're a general, medical practitioner, they're going to have different pay rates. So we're going to look first to industry, then we're going to look at how you're spending your time in your business. What do you do? How do you do it? Are you working on sales, marketing, or technical aspects of your business? I don't know, how are you a practitioner in that business? Well, those types of things will all drive reasonable compensation. So if you are unsure, if you're listening to this and you're like, I just have no idea how to set my salary, it is a great idea to reach out to whoever your tax preparer is and let them help you to complete a reasonable comp study. It's pretty easy to do, but it needs to be done for sure in order for us to make certain that we're not paying you too much or too little, because certainly you don't want to pay any more self-employment taxes than you have to, because you could take the remainder of the cash you need out of your business in the form of a distribution. So, and then the last question I have on here is down to, can I commingle my business and my personal transactions? And the answer is no. The answer is always no to that. One of the main reasons, and a lot of attorneys, they will advise on this, is that, and again, I am not an attorney, but in the attorneys that I've spoken to, that they make it a big point to talk about with business owners of the whole reason that you created an LLC was to segregate your personal risk from your business risk. And when you commingle your business and your personal transactions, you're essentially blurring those lines. And so if there were to be some type of dispute in the future, and someone looked to your business and they said, hey, we think there might be some type of dispute with this entity, and they saw a lot of personal transactions in your business, the attorney may say, there is no corporate protection because you've essentially pierced the corporate veil. You have not protected and preserved the business enterprise on its own. You've blurred all the lines, and now essentially they can bust through the protections of the LLC to get to your personal assets. And that should pretty much scare everybody because there is a lot of danger in us having risk to our personal assets. And we want to use the LLC or any other type of business entity in such a way that it protects our personal assets from the operations of our business. I mean, there's an inherent risk in everything we're doing in our businesses, everything, from having employees to operations, credit disputes, you name it, the businesses are fraught with risk. So it is really important for business owners to get anything personal out of their business. Now, does this mean that from time to time, you might accidentally use your business credit card to buy something personally? It's going to happen. It will happen from time to time. What we're saying is in instances like you don't want to pay your mortgage out of your business. You don't want to be paying your kids' private school tuition out of your business. You don't want to be paying for your, the nail salon and clothes and all these other things that we know are personal and will never be perceived as business transaction out of your business bank account. If you need money out of your business, you transfer money from business to personal and you pay for that stuff out of your personal bank account. And that's the best way to really protect your personal assets as well as protect your business. So, okay, I've made it through all of my questions that I've remembered that people asked me about. And I think we've got a few things here that people have questions on. So I'm going to kind of just read these real fast. I'm hearing from several newer business owners, they're looking to convert S-Corp to C-Corp to take advantage of the qualified small business tax-free gain up to $2 million. Can you comment on what you're seeing and recommending for new businesses and smaller companies? Yeah, there are definitely some options when it comes to the qualified small business stock transaction, having that tax-free gain. I think this really goes back to just tax planning in general. What we find is that most business owners start out and they never really formulate any type of strategic tax plan. So I would say that the thing that we work with a lot of business owners on is we start to talk about what's next. Where are you going? What is next for your business? What are you anticipating in terms of a sale? What's your exit strategy? How are you going to be functioning in the future? So I think we really got to chalk this up to where are you going and what are you going to be doing? I mean, there's a lot of different ways to exit from a business. So that could be employee stock option plan. That could be selling it to people, other employees. That could be just third-party sale, where this would be an applicable strategy. There's all sorts of things. A lot of times business owners really don't even know what those options are. And it is important from a tax planning perspective to really map that out. So succession planning, exit strategy planning, all that stuff really just has to go into what I would refer to as just your annual tax plan. Sit down and you got to talk to us about where you're going, what your plans are, what you want to do, what opportunities are on the horizon for your business and for your industry. Because we know we've seen lots of different things happening across a variety of industries, from veterinarian operations getting acquired by PE companies to, even accounting practices getting acquired by PE companies to, to people, merging operations, physicians, getting their, buying, selling their operations to hospital groups and then getting paid on production. There's all sorts of different ways for that to happen. So tax planning is the key. Okay, strategic tax planning. Another question, will I keep the same EIN number as an LLC when I make the S election? So yes, you keep the same EIN number. It makes it super simple, really easy. Most of the time, the way that this works is I'm a single member LLC. I formed my entity with the state. I applied for an EIN number with the IRS. I received it. That's awesome. And then later, as I start to make more money, I say, I want to make an S election. I just make an S election. Everything else in your company stays the same. No new bank account, no EIN number. You don't have to change your books, nothing. You're just making that election and just your tax treatment is changed. So that's all. All right, fantastic. And it looks like there might be a few other questions. Someone's mentioning profit sharing plans, cash balance plans, 401k plans, and for those that need a larger deduction. Okay, so yeah, let's talk about retirement planning. This is probably one of my biggest, my most favorite areas to talk about. And I'm gonna stop sharing real quick just so we can kind of focus. So retirement planning. So one of the areas where we see, especially people who have their own business, there's few employees. So for example, I am an S-Corp owner. It's me, and maybe I have a few very, long-time employees, and I make a lot of money. I need more tax deductions, but I don't want to just pay other people, right? The last thing I want to do is spend money just to spend money. I want to spend money that I can keep in my pocket. And one of the biggest ways to do that is to shelter it into a retirement plan. So the cash balance plan, probably one of the most exciting things that a lot of business owners miss, who otherwise would have some flexibility to participate. So I'll kind of give you an example of how this works. So I'm an employee of my company. Maybe my company is making a couple $1 million a year. I pay myself about $500,000 a year. And I need more deductions. I'm getting hammered on the individual taxes, and I want to shelter as much as I can. So what I might do is I set up a 401k plan, and I pair that with a cash balance plan or defined benefit plan. That is essentially a pension plan for myself and for my employees that I fund from my company. So depending on my income and my age, I might be able to shelter anywhere from $100,000 to $400,000 a year into my retirement plan, and my company gets an expense. And the way I like to look at this, I literally am moving money from one pocket to another pocket, and I'm getting a deduction. And I am using it as a way to fund my own retirement. I am reducing my taxes right now, potentially pushing myself into a lower tax bracket. I'm also creating a talent retention plan for my employees, because I'm going to be funding some for them. But most importantly, I am keeping the money in my pocketbook while reducing my taxes. So cash balance plans, if you are not currently examining this, I would definitely just complete a feasibility study. Even if you've got 5, 10 employees, it could be a really powerful tool. I will say that the older you are, the more advantageous it becomes. So if you're 25 and you're making a lot of money, it's probably not going to be as beneficial of a tool, because your employees are probably going to be older than you. But if you are 40 plus and your employees have a tendency to be younger than you, then it's going to be an amazing tool for you to use, and you should at least look into it. So, if you have any questions about that, we can definitely talk about it. Okay, question is, what are the possible ramifications of an S-Corp that cannot afford to pay an owner a reasonable salary? Can you get away with paying yourself a minimum wage? Okay, that's a really great question. Yeah, the IRS gives you some flexibility when it comes to if you start off a business and you are an S corporation and it's just not financially feasible for you to pay yourself a salary, you do have the ability to reduce that amount or not pay one at all. It is not something you want to continue year over year, especially as you start to make money. But if you just have a bad year and you don't make any money, you don't have to pay yourself salary. So that's a really important concept for a lot of people. Now, if you take money out in the form of distributions, right? So you have somehow figured out a way to pay yourself a distribution, but you've not paid yourself a salary, that's where you can get into some trouble. So just make sure that you're actually contemplating the fact that, if it is financially feasible for you to take out a distribution, that you are paying yourself a salary, even if it's a small amount. So, I mean, the IRS will look at that. Now, that's not necessarily going to be one of those things where you're going to get dinged on, selected for audit if you don't have a salary in a year where you've got a loss in your business, even though you've taken a distribution. But you need to understand, if you were audited, it could potentially be a bone of contention with the IRS. You really got to balance out all the things that are happening from a compliance standpoint and from an operational standpoint. You just got to be thinking about all of those things. Okay, another question about, do S-Corp owners have the option to have the company pay them for car leases and home office so that they can get money out of the company? Yeah, so this is applicable not only in an S corporation, but it is also applicable to pretty much every other business. So your business can reimburse you for the use of your vehicle. It can reimburse you for the use of your home office. And anytime a company is reimbursing you, you're essentially benefiting from a deduction. And then you don't have to pick up the income on your personal taxes because it is a reimbursement. So it is really important for us to contemplate that across all businesses. And for anybody who's not doing the home office, I mean, especially with COVID, you're missing the boat for sure. I mean, it is definitely a way for you to get a deduction. And if you do not have a home office reimbursement template, I mean, you can go out to our website, www.mbgcpa.com, and we've got a template out there that you can grab, or you can email me at sbryant@mbgcpa.com, and we'll send you ours. We definitely want to make sure that everyone's taking advantage of that. Okay, well, it looks like we are right here at the end. I know I didn't get to everybody's questions. I thank you so much for all of them. I will make sure to answer them perhaps in my next blog post, so I can kind of make sure that everyone gets their questions answered on S-Corps. I know this is a really hot topic for so many people. If there's anything else that we can do as your accountant, or if you're looking for an accountant, someone to help guide and direct on all of these things, as well as many of the other areas of tax compliance, we would love to be a resource to you. Again, my name is Susan Bryant. We're with the MB Group. You can find me at sbryant@mbgcpa.com, or check out our website, www.mbgcpa.com. And I hope you guys have a really great rest of your day. All right. Thanks so much. Talk to you guys soon. Bye.